Welcome back. You're watching Buy Now, Sell Now, and it's time to once again get connected with the management. And we'll be talking about Smartworks that has turned to profit in Q4 year-on-year basis. Strong Q4 for Smartworks, and definitely revenue has soared up almost 45%. To talk more on this, we are joined by Harsh Binani, co-founder, ED Smartworks. Hi, Harsh. Welcome to the show, and congratulations. You reported a very strong numbers on an annualized basis. You have turned net profitable. Can you please tell us how long this growth is sustainable now? How are you understanding these numbers?
Good morning. Firstly, thank you so much for having us this morning. FY26 has been a landmark year for Smartworks. Not only it has been our first year of listing, but it has been a year of several firsts. As you rightly mentioned, we have crossed more than 1 crore square foot of operational footprint, which is the first listed flex platform to do so. And this is also our first full year of accounting reported profitability. While the company has been cash-wise profitable for the last 5 years, but the accounting milestone is also a major one. And as we now move forward into FY27, the company is already at a contracted rental revenue of more than 5,200 crores. So very interestingly, FY26 has not only proved the validation of the business model, but firmly driven our compounding thesis. So you have clearly seen that our growth is now upwards of 30%. Our margins have improved by more than 75% year-on-year basis. But most importantly, the cash flow and the ROCE profile of the company has improved very meaningfully. So you're seeing growth, margin, cash flow, and return all improve together. And that is where the story continues to get more exciting. As we now move into FY27, happy to share that more than 82.5% of our revenue for the year is already contracted. So to your question around sustenance of the current growth, we firmly believe more than 30% revenue growth is well on cards. We will end the year by adding another 2.5 to 3 million square foot of operational area. And we expect that our EBITDA, which closed at 17% for the entire year, but the quarter ended at about 19%, we expect to maintain that and rather improve on that. And we also expect that our ROCE will continue to improve fairly meaningfully from the trajectory it has taken.
Mr. Binani, hi, Ankita also joining in. How many seats have you added in FY26 and what is the seat addition guidance for FY27?
Sure, Ankita. Thank you. So FY26, the company had operationalized more than 2 million square foot. And we had sold a net seats of more than 40,000 seats. So the trajectory is now going to double in the coming year. So this year, we will end the year at close to about 12.5 to 13 million square foot of operational area from the 10 million square foot that we are currently at. And the sales velocity that we've demonstrated, largely because of the large GCCs we've signed up last year and the mega 1,000+ seater deals that we've done across the board in all the cities that we are present in, should augur very well for ramping up the occupancy of all the new capacity that we are adding in FY27.
All right, Harsh, what is the demand you are seeing in GCC segment now, specifically going ahead?
India firmly is the GCC capital of the world. And last year was able to demonstrate very clearly that not only is GCC coming to India in a very big way, but they've also chosen flex as a default choice. And going forward, we expect that another 16 to 20 crore square foot of GCC demand is going to come up in the next 3 years. And there are several reports which speak about how more than 40 to 50% of that is going to come to flex. So that is going to be one big demand driver. But if we had to just take a step back, India's total commercial stock is close to about 1 billion square foot, which, take it or leave it, is still less than New York in entirety. And flex space within this is about 10 to 12%. So we've become the largest category now, Ankita, in the world for this. And Smartworks has been growing significantly faster than the CRE industry, but also more than flex. So we've been gaining a lot of market share. And going forward, we expect that while GCCs will continue being a major demand driver, but we are also serving a lot of Fortune 500 companies. We are also serving a lot of new AI-led companies which have been absorbing a lot of space. So that's where the flexibility also comes. But most importantly, a lot of the traditional occupiers who are used to the long leases, 9-year conventional rigid leases, we are seeing a lot of rollover of contracts coming over which is what gives us the conviction and confidence that while new companies, GCCs will continue to absorb space, but the more fundamental habit shift which has happened, which is to get traditional occupiers to move to flex, will also augur very well for a unique differentiated platform like ours.
Right, Mr. Binani. Thank you. On that note, we are completely timed out on this discussion, but it was a pleasure to have you on the show. We will quickly go cross and cut into the HUL